So, welcome back. In this video, I'll be talking about the book by John C. Bogle called The Common Sense of Investing. I hope you enjoy it and let's get started. But before we start, we have to quickly talk about who is John C. Bogle. John C. Bogle is the founder of the Vanguard Group and the creator of the first index fund, the Vanguard's S&P 500. Here you see a picture on the right side from John C. Bogle and his given fund. Okay, now that you know the basics about John C. Bogle, let's continue with Chapter 1, the Gottschalk family. In this chapter, he explains the stock market and counterproductivity of our vast and complex financial market system with a story from Warren Buffett. There was once a wealthy family named Gottschalks, which owned 100% of every stock in the United States, essentially the whole stock market. After some time, fast-talking helpers arrived and promised to outpace the stock market. The members got fooled, the helpers did their transactions, and as brokers do, they received commission for their services, as well as increasing taxes, so the family wealth started to grow at a slower pace. Essentially, they got more and more helpers, which further reduced the growth of family wealth from the original 100% of earnings and dividends to just 60%. The rest went to the so-called helpers. After some time, the family realized that instead of increasing wealth growth, they reduced it to just 60% of the original 100. Upon this realization, they cut all helpers, brokers, consultants, money managers, and lived happily ever after enjoying 100% of earnings and dividends. The moral of the story? For investors as a whole, returns decrease as motion increases. Mr. Bogle explains that index funds do exactly the opposite, decreasing motions and thus increasing returns for investors and not the investment business. Well, that was all about chapter 1. Let's continue to chapter 2. Shareholder gains must match business gains. He begins this chapter by another quote from Warren Buffett. The most that owners can earn between now and Judgment Day is what their businesses earn. Further, he divides the total stock market into two parts. Investment return, enterprise returns, consisting of the initial dividend yield plus their subsequent earnings growth. Together they form the essence of what we call intrinsic value. And second, speculative return, which is the impact of changing price to earnings multiples on stock prices. The PE ratio measures the number of dollars investors are willing to pay for each dollar of earnings. As confidence waxes and wanes, P multiples rise and fall. They often have a significant impact on annual speculative return. A 100% rise in the PE ratio from 10 to 20 times over a decade would equal to a 7.2 annual speculative return. Let's look at the two charts Bogle presented during this chapter. The first one, the one on the top, is investment returns versus market return. The growth of $1 from 1900 to 2016. We can see that a single dollar invested would have grown to an impressive $39,000. However, I doubt that this is adjusted for inflation. We can also see that the huge impact of speculative return had virtually no impact over the long term. The other chart shows us that most of the total stock market return was driven by economics, enterprise returns, that every decade with significant speculative return was immediately followed by a decade in which it turned positive, and lastly, the impact of emotion, speculative, was only dominant in the short term. Chapter 3. Win by keeping it simple. Rely on Occam's razor. The Occam's razor is an expression by William of Ockham and states that where there are multiple solutions to a problem, choose the simplest one. By far the simplest way to own all of US businesses is to hold the total stock market portfolio or the S&P 500, which holds the top 500 highest market capitalized companies, 85% of the total US market. Further, Bogle quotes that the returns earned in the stock market must equal the gross return earned by all investors in the market, and that the net return earned by investors consists of the gross return in the stock market minus the intermediation costs. A low-cost index fund is guaranteed to outpace the returns earned by an equity investor over time. He shows us the actively managed mutual fund that were outperformed comparable to the S&P indexes. We can see that about 95% of the large cap were outperformed, 97% of the mid cap, and 99% of the small cap. both in growth. For core, there was 97% for large cap, 99% for mid cap, and 95% for small cap. And for value, there were 79% for the large cap, 90% for the mid cap, and 81% for the small cap. We can see that basically the S&P index outperformed the mutual funds by a lot. Chapter 4: The Relentless Rules of Humble Arithmetic. This chapter he explains that investing in mutual funds is before cost a zero-sum game and turns into a loser's game after cost. Mr. Bogle makes a powerful and accurate quote: "We investors as a group get precisely what we don't pay for. If we pay nothing, we get everything. In other terms, if we have no costs, we get the whole pie. The more cost, the less return we get. The humble arithmetic is just that, keeping costs low to increase return by investors. This explains the failure of the mutual fund industry, as they have high costs relative to the index fund, where the costs are way lower. But why do most of the investors ignore costs? It's one of the three reasons. First, because of the recent high returns by the stock market. Second, the focus on short-term returns, and third, when costs are hidden from view. For example, portfolio transaction costs, front-end sales changes, and taxes incurred on fund distributions from capital gains. In the investment field, time doesn't heal all wounds, it makes them worse. Everyone has probably heard of compounding returns, but not only those compound, costs also do. Here you can see a chart showing the impact of compounding. With an assumed return of 7% before costs, an investment of $10,000 would have grown to nearly $294,000 over 50 years without any costs. With 2% costs, a 5% return, that investment would have grown to just $114,000, not including inflation. Chapter 5: The more managers take, the less investors make. There are three types of costs in a fund. First, the fund's expense ratio, which changes little over time and varies from 2.4% to 0.32%. Second, the sales charge paid on each purchase of shares. With time, they disappeared and turned into spread loads, which increased the fund's expense ratio drastically. And third, the purchase of sales and portfolio securities. The transactions made by managers cost a lot of money. A 50% asset turnover would cost about 0.5% per year. Note that funds in the lowest turnover quartile have consistently outperformed those in the highest turnover for all equity funds. If there is anything in the world of mutual funds that you can take to the bank, it's that expense ratios help in making a better decision. In every single time period and data point, low-cost funds beat high-cost funds, because if the managers take nothing, the investors receive everything, the market's return. Chapter 6: Mutual funds confiscate too much of the investor's best friend, the dividends. The dividends are a vital part of the long-term return generated by the stock market. In fact, they have accounted for about 42% of the market's annual return of 10% in the past. The mutual funds confiscate too much of them, resulting in a huge loss for investors. Here's another chart displaying what happens when we wouldn't have dividends. We would miss out on $57 million over the long term. Chapter 7: The returns reported by mutual funds are rarely earned by the mutual fund investor. In this chapter, Bogle explains a hidden cost that is even larger: the so-called dollar-weighted return, which accounts for the capital flows from investors into and out of the fund. It is simple investor behavior that penalizes funds. While index funds' returns are not as much handicapped by this, the average large-cap fund is hugely impacted by this. Just look at this chart. While the average investor's return for the index fund is $73,000 of the original $79,000, the average cap return dwindles to just $55,000. If we then take inflation into account, you get the point. Mr. Bogle also started another obvious fact proven again by charts. People poured money into equity funds mostly during market peak, right before it's about to drop. Just pause quickly and take a look at this. This concludes that investors' emotions in industry promotions equal big trouble. A quote from Warren Buffett states, "The greatest enemies of the equity investors are expenses and emotions, the 4 E's." Let's continue with Chapter 8. Don't pay Uncle Sam more than you should. In Bogles' eyes, another cost that is too often ignored are taxes. This is what he had to say about them. Managed mutual funds are astonishingly tax inefficient. This inefficiency is destined to continue as long as stocks rise and fund managers continue their hyperactive trading. On One of the most important things you can take away from this video is that fund returns are devastated by costs, adverse fund selection, bad timing, taxes, and of course inflation. This is why you have to especially care about these topics and how you can avoid them. Chapter 9. When the good times no longer roll. In this chapter, Bogle talks about the future returns of investments over a 10-year period. We have to consider the start of the period was early 2017. In short, he warned in this chapter that common sense and humble arithmetic tells us that we'll face an era of subdued returns in the stock market. His guess was an annual rate of return of 4% in the stock market, a real return of 0.1% including inflation. If I have looked correctly, we are as of 2025 on a 13% annual growth rate from 2015 to 2025 and 70% for 2020 to 2025. Not real return as it's not adjusted for costs, nor inflation, nor taxes. Because of the expectation for a very low outcome of the stock market, he advised again to select very low cost index funds with rock bottom costs. Again, while this wasn't the case as of early 2025, we still have 2 years before us and only time will tell how the returns will look. Chapter 10. Don't look for the needle, buy the haystack. You can skip this chapter as it's only for those who are thinking that they could select good mutual fund performers. First of all, let's look at the chart. Looking at it, we can see that out of the 355 equity funds, there were 281 non-survivors and only 2 of the 355 funds exceeded the market by 2% or more. Allow me to salute them. Fidelity Magellan 2.6% per year versus the S&P 500 and Fidelity Contrafund 2.1%. Both have ridiculous asset growth and have started to decrease. Bogle expressed his opinion on those two in a way that goes like this. It's a pity that they outperformed the market, and looking at the failure rate of equity funds, it's hard to believe that new funds will grow to such an astonishing size. Even looking at other Fidelity funds, we can see that they haven't survived the time. If you live by the sword, you die by the sword. Then he advised us to look before we leap. Before we rush to buy these funds, we should ask ourselves about the odds of a winning fund outperforming, about the huge present size, the reality that every 25 years the fund replaces its managers, and that even a single investor has held shares of the fund for throughout their lifetime. He advises us to not look for the needle in the haystack, but to buy the haystack. This means to rather invest in index fund than to invest in 30 to 40 mutual funds to get even a slight chance of outperforming the market. Alright, let's continue with chapter 11. Yesterday's winners, tomorrow's losers. In this section, Mr. Bogle explains us an important concept of reversion to the mean, RTM, which is a theory that prices revert towards their so-called mean or average level. He then further proves that mutual funds can't outperform the market. Let's look at the data he provided. First of all, he used the 2006 to 2011 highest to lowest rated returns, which were rated by Morningstar, and compared how they performed in the next 5 years. We can see that 27% out of the 353 highest return funds had the lowest return over the 5 years, with a steady reversion to the mean of about 16%. He claims that if it were easy to select funds that outperform by looking at past winners, we would see persistence. Nothing would change. As it turns out, RTM overpowers persistence. The old saying of past performance is no guide to the future. It's not just a saying, it's the truth. Out of pure luck, a population entirely composed of bad managers will produce a small amount of great track records. The amount of managers with great track records depends on the number of people who started in the investment business. To statistically prove that a money manager is skillful and not lucky, it takes about 20 to 800 years of monitoring performance. Chapter 12. Seeking advice to select funds. This chapter was all about financial consultants. While he agrees that you must avoid helpers at all times, he suggests that you should probably consider hiring a registered investment advisor (REA) as they help on asset allocation guidance, information on tax considerations, and how much to save while you work and how much to spend while you retire. However, you should keep fees in account and think for yourself how much the given REA provides value. Also, REAs are not stockbrokers. Never trust stockbrokers. This was all what he had to say in this section. Let's continue with chapter 13, Profit from the Majesty of Simplicity and Parsimony. At the start of this chapter, he sums up what we have learned throughout the book. First, costs matter. Second, selecting equity funds based on their past performance doesn't work. Third, fund returns revert to the mean. And fourth, relying even on the best intentioned advice only works sporadically. Then he shows us the chances of a mutual fund outperforming a passive index fund. As you can see, over the 50 years there is only a 2% chance to outperform the index fund. Again, he sums up the different things that kill the return of the actively managed funds. To conclude, expense ratios, sales charges, turnover costs, tax costs, and the most devastating one, the inflation. Also, he warns about other passive index funds that hold sales charges and high expense ratios and suggests to buy Vanguard's low-cost S&P 500 index fund, of course. Chapter 14, Bond Funds. A single factor dominates the return earned by investors in the bond market. That is, of course, interest rates. But why should you hold your money in bonds? Well, the long run is a series of short runs, and in those bonds have provided higher returns than stocks, according to Bogle. And second, it gives you downside protection during high market declines, an anchor to the windward, so to speak. Well, now that we know about bonds, but which bonds to choose? You can choose between short, medium, and long-term ones. Long-term bonds are for maximizing yield but carry higher volatility. Short-term ones carry low volatility and thus minimize yield. And while medium, as you probably guessed it, are just a balance between the two. To conclude, the value of bond index funds is created by the same forces that create value for stock index funds. Broad diversification, rock bottom cost, disciplined portfolio activity, and tax efficiency is advised. Well, that was all about chapter 14. Let's continue with the exchange traded fund, ETF. In this chapter, he goes forward to express his opinion on ETFs. Here is what he concludes about the ETF. There is nothing wrong with investing in those index ETFs that track the broad stock market, as long as you don't trade them. The counterproductive investor's behavior, given by the flow of cash, is usually much more volatile than cash flows experienced by traditional index funds. However, ETFs profit a little bit more when it comes to tax efficiency than the index funds. So, to conclude, if you like the idea of ETFs, invest in the appropriate ones and don't trade them. I repeat, do not trade them. Chapter 16, The New Paradigm. Mr. Bogle talks about the new types of index funds that emerge. These so-called smart beta managers create new index funds that focus on different factors rather than on the traditional weighting, which is the market capitalization. He warns about such new index funds and shows us another chart to prove his point. In this one, we can see that while the fundamental index fund had an increased annual return of about 0.7%, the risk-adjusted return measured by the Sharpe ratio was a higher for the traditional index fund. As the annual return increased, so did the risk by an unproportional amount. Finally, we should ask ourselves, among similar portfolios, do we prefer a certain relative outcome or an uncertain one? Is it better to be safe than to be sorry? Chapter 17. What would Ben Graham have thought about indexing? It follows from this reasoning that the majority of security owners should elect the defensive classification. This is a part of a quote Bogle presented and what is the best option to fully emerge in defensive investing? That's right, index funds. Let's look at another quote from Mr. Graham reassuring this. The real money investment will have to be made out of owning and holding securities for their dividends and benefiting from their long-term increase in value. He also lays forth that Graham's 1949 strategy was a precursor to the 1976 index fund. I summed up the next two chapters as they were both on asset allocation. About 94% of the difference in portfolio returns is explained by asset allocation. He narrows asset allocation to just two things. First, the ability to take risk, and second, the willingness to take risk. The ability to take risk depends on your financial position, your future liabilities like retirement income, college tuition, down payments for a home, and how many years you have available to fund those liabilities. As you accumulate more assets, your ability to take risk increases. Second, the willingness to take risk is a matter of preference. Only you can answer. If you can't sleep at night because you are worrying about your financial decisions, you are probably taking more risk than you can handle. Both ability and willingness make up the risk tolerance. Of course, age matters, as young investors don't face the challenges that some older ones do. Also, they have way more time to invest, allowing to negate the short-term ups and downs of the market. In the rest of the chapters, he explains that it really just comes down to your preference, risk tolerance, and age. Further, he suggests choosing Roth IRAs for younger people, as older people typically have traditional REAs, and change from one to another entails taxes. The last chapter, chapter 20, Channeling Benjamin Franklin. This chapter was more about similarities with Benjamin Franklin and John C. Bogle, and here are a few of them. First, Bogle. To be a successful investor, you need information. If information about past returns earned by mutual funds, especially short-term returns, is close to meaningless, information about risk and cost is priceless. On the market, one man may be more cunning than another, but not more cunning than everybody else. This from Franklin. And Bogle, don't think that you know more than the market. No one does. And don't act on insights that you think are both your own, but are usually shared by millions of others. On safety, Franklin. Great estates may venture more, but little boats should keep their near shore. Bogle. Whether your assets are great or humble, diversify in a portfolio of stocks and bonds. Then only market risk remains. Investor of modest means should be especially cautious. On forecasting. This is easy to see, hard to foresee. It takes wisdom to know what we don't know. On looking after your own interest, Franklin. If you would have a faithful servant, serve yourself. You must never ignore your own economic interest. And finally, on steadfastness. Franklin. Industry perseverance and frugality make fortune yield. Bogle. No matter what happens, stick to your program. Think long term. Patience and consistency are the most valuable assets for intelligent investors. So, my opinion on this book, let's start with the good ones. First of all, it's an amazing book. It shows how simple but not easy it is to invest, and that everyone can earn their fair share of stock market returns. Especially, most of the things are straightforward, and there's a lot of charts and facts backing this up, and it's really written in an easy way to understand and to comprehend. Second, things that I didn't like where he talked really much about these mutual funds. He really often talked about those funds, and it was kind of getting on my nerves in the later chapters, so chapter 15 and onwards. And especially, he was always advertising those index funds, even though I believe that ETFs are, if you held for the long term, a little bit better, but he's not. Don't have the same opinion. So yeah, as with any book, it's partially good, it's true, and you just really have to pick your own important information out of it, and then you make your own conclusion. Not every book is true in on every page, in every chapter. Some always will have things that you can agree more on, and some things that you can agree less on. So yeah, that's my opinion. I hope you like this video, and have a great day.